Hello, ladies and gentlemen, and welcome to Valuation Masterclass Bootcamp Graduation Presentation. Tonight's presentation we're going to see is the company Paccar, and I've never seen this company's financials and such a report, so I'm really looking forward to learning more. Earlier tonight, we looked at Volvo, then another graduating student looked at Daimler, and now it's time for this company in America, Paccar. So let's bring on our student. Here we come. Hold on. Let me bring you in. 1 second. All right. Sierra Road, how are you?
I feel very excited for this presentation.
Yeah. Well, in one of my corporate strategy courses, I talked about the strategy of this company, even though I'd never valued it myself. And so I've always wanted to dig a little bit more into it. So I'm very much looking forward to tonight. So let me try to share the screen. Hold on. See if we can do that. Yep. And I see the screen. And you want to just go up and down 1 second just to make sure. There we go. Okay, perfect. All right, I'm going to leave you in just a second, and then you take over. Are you ready?
Of course, better than ready.
All right, that's what I want to hear. So I'm going to leave now. Take it away.
Among the companies in the truck industries, there's one company with strong fundamentals and growth potentials. And despite the short-term challenge, I believe the company still has long-term gain. Ladies and gentlemen, my name is Sia Rose, a business school student in the field of finance from Kasetsat Universities. Today, I'm going to deep dive into the company that might have been overlooked by the market, Paccar. I initiate coverage on Paccar with buy recommendations based on a target price of 124 US dollar, implying an upside of 25%. I derive my target price from a DCF-based valuations using a cost of equity of 11% and a terminal growth rate of 3%. My key highlight is CapEx increase would be a foundation of long-term growth and profitabilities. And my key risk is economic and politics risks. So without further ado, let's start with the background of the companies. Founded in 1905, Paccar is an American corporation that designs and manufactures commercial vehicles, operating under the Kenworth, Peterbilt, and Dodge brands. The company is among the top 5 major players in the industries, with the market shares of 15%. And Paccar core strength is to focus on high-quality trucks and advanced technology integrations reinforce its strong market positions. My story is long-term gain, but short-term persist. What does it mean by that? Let's see. CapEx increase would be a foundation of long-term growth and profitabilities. So Paccar plan to invest around 750 million US dollar in CapEx in 2024, a 15% increase from 2023. This investment focused on expanding manufacturing capacity at its truck factories in Mexico and Ohio. This capacity would serve the expansion plan in a key geographic area, particularly in North America and South America. I expect it to boost capacity by 15% over the next 3 years. Furthermore, the company expects 8% CAGR growth in the parts segment, which has higher gross profit margin at 30% and would be supported by the construction of a new part distribution centers in Massbach, Germany. This initiative could significantly increase revenue growth to be around 11% from 2026 to 2028. The second one is the interesting one. Emission-free trucks are on the way, yet these sales remain a growth driver. In 2023, the company sold only 270 electric trucks, accounting for less than 1% of the total sales. I anticipate that the diesel trucks are still a growth drivers for the company. The reason behind that is the electric trucks remain significantly more expensive than their traditional counterparts. Additionally, emission-free trucks currently lag behind diesel in the key areas such as range, payload capacities, and the availability of charging infrastructures. As a result, a substantial shift in demand for diesels to electric truck is unlikely in the next 5 years. The third one, economic uncertainty in Europe has an impact on Paccar revenue outlook. After a recording-breaking years in 2023 with over 200,000 units sold, 20% of which were in Europe, Paccar management anticipate an 12% revenue decrease in the regions due to an ongoing economic uncertainty and high inflation of 3%. I expect this challenged economic environment to slightly decrease overall revenue by 3% before recovery begin in 2025 and an 11% revenue growth in over the following 3 years. Now, let's take a look on the industry overview. Truck makers ride a wave of innovations. The truck manufacturing industry market's value is expected to grow at 9% CAGRs, according to the Global Market Insights. The growth is driven by infrastructure investment, a push of fuel efficiencies, technological advancements, and e-commerce expansions. Despite growth, the sector still faces the challenge of emission-related R&D costs. The industry must adapt to evolve technologies, regulatory change, and market demands to remain competitive. Now, the truck manufacturing sector is set for a major change. This surge driven by hefty infrastructure investment and a push toward fuel efficiencies. Electric trucks are gaining traction due to strict emission standards and technological progress. Overall, the industry is rapidly evolving in response to both regulatory pressures and technological innovations. And lastly, the transitions to electric truck would put pressure on margin in the short terms due to higher costs. Battery alone make up 28% of the traditional of the total cost, and even in the optimistic scenario, show that battery electric trucks are 15% more expensive than the traditional trucks. As a result, companies that increase their sales of electric trucks and the emission-free trucks may experience a significantly decline in gross profit margins. Now, currently in 2024, in Q1 and Q2, Paccar experienced a revenue decrease, which resonates with my stories. Moving on to the consensus estimations. Over the last 3 months, around 67% of analysts hold the neutral view on Paccars, while 29% recommended buy in the stocks, and over one analyst hold a sell recommendations. The mean target price of $110, which imply an upside of 11%, supporting the overall consensus recommendations. Regarding to Paccar revenue structures, in 2023, Paccar total revenue reached an all-time high of $35 billion. This revenue can be derived into 3 primary segments: trucks, parts, and financial service. The truck segments ran the largest contributions, accounted for 77% of the total revenue, followed by parts segment as 18% and financial service at 5%. From the geographical perspective, the United States and Canada are the largest revenue contributions, representing 56% of total earning. Now, take a look at this slide about fundamental valuations, momentum, and risks. Paccars appear attractive relative to 1,810 non-financial companies in the US, with the key highlight on valuations and risks, which is almost in the first percentile compared to peers. Additionally, momentum and fundamental are slightly above average. And when considering the world-class benchmark, the exceptional profitability growth of the company is derived from both profitability and growth, although the asset efficiency is slightly above average. Strong expense control has more than offset the moderate asset efficiencies. Additionally, the revenue growth and expense direction is in the good spot, despite the slightly decline in the past 12 months. Regarding profit and loss, I predict a 3% decrease in Paccar revenue in 2024. However, I anticipate 11% growth in 2026 to 2028. I expect the overall asset of the company to be increased as the company has strong expansion plan and required more long-term debt to fund that asset. I expect the company cash flow decrease in 2024 and graduate increase as the sale growth, and also more cash to spend in CapEx In the term of ratio, the current ratio could marginally increase, and I believe the inventory conversion periods to slightly increase in 2024 due to the decrease in sales, then graduate decrease to the normal point at 2026. I forecast the revenue growth to be around 11% in 2026, with slightly decrease in 2024. And the increase in 2026 net profit margin is due to the increase of part segment, which has higher gross profit margin, as I said earlier. And here's the free cash flow data, which show similar trends based on my stories and the financial forecast. Let's take a look at the valuation part, starting with the relative valuations. On the forward 2025 PB multiplier, Paccar trades at a discount to the industry sector in both US and globally. I forecast ROE to be around 24% in 2025. The result in Paccar trading at a discount based on the 2025 PB to ROE multiplier, which showed that it's undervalued. Moreover, on the forward 2025 PE multipliers, Paccar also trade as discount. I expected its EPS growth to be negative in 2024 and expect the 2025 EPS growth to be 8%. And when using the 2025 PEG ratios, the company looks cheap relative to the benchmark. Regarding the DCF valuations, I assume cost of equity of 11%. I use free cash flow to equity because the company generates substantial cash and equity comprise 80% of its capital structures. I anticipate a growth margin of around 21%, leading its value of $124 per share. Now, in my sensitivity analysis, the optimistic case assumes gross profit margin of 23%, result in target price of $131. Conversely, in the pessimistic case, the gross profit margin is assumed to be 19%. Hence, our value is $117 per share. Speaking of the risks of the company, Paccar faces exposure to macroeconomic fluctuations and political instability in various markets. To mitigate this, the company has diversified product portfolio and operations in multiple geographic regions, which allow the company to better withstand economic fluctuations. Moreover, Paccar faces risks related to compliance with emission regulations and other legal requirements across different jurisdictions. Lastly, the company relies on a complex global supply chains for parts and materials. Geopolitical tensions, natural disasters, or pandemics can affect production schedules and increase costs. At the end of these presentations, I believe the market has been over pessimistic about the short-term revenue decrease due to the softened sale in Europe. However, I believe that the company still has a strong long-term growth potentials, and I convey this message with the buy recommendations. Thank you for your attention, and I would be happy to answer any question from any audience.
Great. I've got some question. When we look at the margin of the business, it is very high in 2023. And as you've said, it's producing only 200 or selling only 200 electric vehicles, right?
Yes.
So we can say that basically 100% of this business is traditional trucks.
Of course.
So my question is, and it fits with some of the questions that we've had, and that is, I don't know, 5 years from now, what percent do you think EV, electric vehicles are going to be relative to diesel or traditional?
I would say according to my research, it would be around 5 to 10%, but it won't gonna be like 50% or 60%.
And why is that? Because everybody's talking about EVs and all that. What's going to stop this company from going EV?
The reason is very simple. The emission-free trucks has a different powers, have a different capacities compared to diesel trucks, and the gap is very enormous. So my hypothesis is that the buyers won't gonna buy the emission-free trucks, even they have the emission standards.
Okay, and we've got Mohammed's asking a question, which how do you see the threat of the opening of other companies in North America, like Volvo, or expansion plans for the others? What do you think about the competitors to Paccar, and how does the company respond to that?
Okay, so Paccar is the one company that have the competitive advantage in the margins of the company due to the lean manufacturing process. And even though Volvo has been built the plants in North America, I think Paccar still hold the competitive advantage on this. It might affect Paccar, but Paccar still have competitive advantage. Yes.
Mm. Momin had a question where he said, I want to hear your thoughts about this. Could Paccar steal some market share from Daimler and Volvo going forward? If yes, why? Or if no, why?
According to my research, I would say yes. The reason behind that is Paccar environments. Paccar has their own engines. Paccar does have their like very good engines, and they have also the part segment which is very strong. So they can attract more customers due to this competitive advantage of Paccar.
And just another question about the EV aspect. If you think that the company's not going to be producing that many EV vehicles, then you must be very bearish on its revenue potential in Europe, which seems to be going crazy about forcing companies to produce EV. What are your thoughts about the future growth for Paccar in relation to Europe?
In my valuation model, I bearish with the segment in the Europe. That's and as I said, if the efficiency of e-trucks is not going to be good enough, the customer won't going to be changed, even though the government is trying to force the buyers or sellers.
Okay. Another question comes from Zishan, which is, what's the unique thing about Paccar compared to its competitors, Volvo and Daimler, that makes it better? What's the competitive advantage or the competitive moat? In particular, like, are they all producing the same engines, or are they doing their business in different ways?
So one of the Paccar's competitive advantages is they build their engine in-house. So let's say it's like Apple. Apple have built their phone themselves, have built their software themselves, so they can control their environments. I think that it's the same competitive advantage at Paccar's, as they have been built and construct the engines by themselves compared to like Daimler's or Volvo's.
And where are they getting their engines for Daimler and Volvo?
From the third-party companies.
Okay. We have a question from Priyanka. It says, can you provide insights into Paccar's progress on not autonomous trucks? What challenges or opportunities are ahead in this segment?
Okay, this is the interesting one. So I would say that this is one of the risks that Paccar face in the Europe markets. But as I have researched and dig into these particular areas, I think autonomous driver is still not going to be feasible in the next 3 to 5 years.
Oh, so how does it feel to graduate from the Valuation Masterclass Bootcamp?
I feel really excited. You know, from the first day that we start the bootcamp to this day, I feel very changed in my perspective. I mean, to spend a lot of time digging in the, let's say, 10Ks, the annual report, the third-party research. After all that diligence, I feel that it's really paid off, and it has given me the transformation that I was hoping when I started this bootcamp.
You know, I still remember the first night of the boot camp. I saw at one point, I think when we were ending, you were like, yeah, I remember that move. And I was like, what's that? And, but you always brought a lot of energy to the boot camp, which is great. And I want you to bring that, you know, as you continue on, and also bring that to new students that are coming in, because as you know, it can get very tough and very challenging.
Definitely.
And how does the Valuation Masterclass Bootcamp affect your future? I mean, if you think about what you were thinking about your future opportunities prior to the boot camp, where do you think about your future opportunities after you've completed it?
Okay, to address this, I would say that all of my friends in my universities, as I am the fourth year students, all of my friends didn't know how to practically doing the valuations, but I know. So I think that's my competitive advantage in the job market industries. Yeah,
Mm.
something like that.
And what is your plan for the future? What is it you're looking for?
Uh, so in the next months, I will have the CFA exams that
Mm.
I have to took, and following by that, I will compete in CFA Research Challenge.
That you're gonna have your hands full there, that's for sure. I saw Mohammed said, he said, from your first word, I think you're very good at selling. You should go well on the sell side.
Thank you very much.
Yeah. All right. Well, I'm going to take you out of this and we'll come back. I'll talk to you in just a second, but well done.
Thank you.
Yep. How about that? That was a great presentation. He really brought the energy and, some interesting stuff about Paccar. I didn't realize how high quality the earnings are of that company. The return on invested capital is strong, and it's not that expensive. If I looked at it on a price to book basis, if I looked at his valuation, I would say it looks interesting. And what's also fascinating is that if you listen to the news, you'd think that EVs are everywhere, but he told us that it was only like 400 vehicles that they've sold so far, which is tiny out of 200,000. And then his prediction was that EVs would be a small part of their overall revenue in the future, which I thought was interesting. If you want to build a competitive advantage in company valuation like Sierra Road has done, why not join us at the Valuation Masterclass? Just go to valuationmasterclass.com. My name is Andrew Stotz, and I'll see you.